Hi folks, myself Raj. Welcome to our channel Code Shack. And this is episode 4. Today we will discuss about the economy, recession and changes coming due to AI. Also today's video will be a bit longer. Hopefully you guys like it. So let's start. We know that artificial intelligence plays an increasingly important role in our daily life and economy. AI, seen by many as an engine of productivity, AI deeply transformed the way in which modern societies live and work. Like we already use smartphones with smart assist such as Siri, Alexa, they perform variety of tasks for users. Furthermore, if we take Tesla cars, they are connected and things they do are all AI based. Also, AI matches the prices and cars when we book it from Uber for a Uber ride. AI also helps social media in offer to a user based on their past behaviors or how they are using the social media. Based on that, AI generates the offers. With the rise of AI, the most important questions uh, arises: how it will affect businesses, consumers, and economy in a more general terms. There is a global accord that AI may have the potential to reform production and contribute in addressing major global challenges. Or the AI can help us to control more challenges globally. But there is an IMF report came out that shows that AI may have potential impact on the global labor market. Many studies have predicted that jobs will be replaced by AI. Almost 40% of the global employment is exposed to AI. So yeah, there is good side as well as a bad side for the AI, but we can for now we can take the good side. And also then comes the big question: how are central banks taking AI effect in the economy? Are we expecting any rate cuts in this year? Surely, central banks will probably continue to push back on the expectation of rate cuts for their scheduled policy announcement in coming weeks. Even though inflation and the wage pressure moderated considerably, our team believes that the Fed or ECB or Bank of England or Bank of Canada will cut rates in the first half of this year, as the drop of inflation across advanced economy has pushed the real interest rates to rise by even more than the nominal interest rate. So, as the inflation has contracted, the real interest rate began to rise, and it's even more than the nominal rates now. As per this condition, we will probably see large rate cuts in nominal rates in coming months ahead. Definitely, as per the conditions now, we can expect large cuts in coming months now. But there are some underlying geopolitical tensions running across the globe in multiple regions that is contributing to unstable global order, eroding trust and insecurity. Like prolonged Middle East tension can push the inflation upward, as there is the Red Sea issue and there is the crude oil supply issue. If the oil price goes up, definitely there will be push in the inflation upward, towards upward. So there is always a risk stays behind us as long as the Middle East tension stays over there. Also, also the questions or the big question comes now: will we see a hard landing or a soft landing? To determine whether we will see a recession or not, we have examined a few data like economic growth, then employment, then wages and prices. From a macroeconomic perspective, the economy looks standstill. Even after so many rate hikes, it's rock solid. Job rose above pre-pandemic level. Price of goods came down, wages moderated, and the economy also grew in the last quarter. From our team, question remains regarding GDP and GDI. As we know that the GDP uses the value of goods and services produced, while GDI uses income earned in producing those goods and services, as they are measured with different source of data. There is a statistical discrepancy between them due to the measurement errors in estimating their component. Averaging the two may sometimes give more accurate picture of economic growth than either alone does. But it is a difficult to identify the source or the sources of the measurement of errors. So our question remains in the GDP report from the last quarter by the government. And also there are challenges still remains or on the ongoing economic expansion. There, as the central banks are determined to cut their rates, economic expansion will have lots of challenges. As very much possible to see the inflation to come back as the central bank starts rate cut. As we can see, the market is up, the wages are up. So probably as the rate cuts began, we will be seeing inflation might go up. Many fears still remains as the most recent report came up, like the average credit card balances jumped almost like 10% to a historic record 6,360, and more consumers are falling behind on payment. Also, there may be a chance of another bank run, like we see in the last week. NYCB stocks plummeted as they reported massive fourth quarter loss. NYCB is suffering from commercial real estate lending. Office and multifamily property could create a very sensitive issue for the overall economy. Also, we can see the layoff is continuing and we will see more in coming months. Big players like Meta, then Amazon, then Microsoft, then Google, then Salesforce, they let go around 25,000 employees. According to layoffs, FYI, 93 tech companies laid off 24,584 employees in 2024. It's all because like spending was just way too much in 2024 by these companies. So that's causing a trouble for businesses in 2024. One big reason for this trouble is trying to reduce the cost. That's the major cause the companies letting go for the employees. And another reason is like if they do not reduce the cost, that might affect them in the bottom line, like in the net profit. If the bottom line is reduced, then the price of the share will be affected, and that will upset the investors or the shareholders. So the companies, the big techs, they probably would take off laying off more employees rather than upsetting their investors or shareholders. AI, then also there is the AI effect. AI also taking over the overall economy. Report shows that nearly 75 employees are laying off workers to save money, and about 40% are bringing in AI. Like almost the companies are laying off employees and they are bringing in AI to cut those jobs, to save money, and to reduce cost. As we study the market and compare the S&P 500 with and Nasdaq with Russell 2000. Russell 2000 is a small cap index. Then we see that the small cap index, that is Russell 2000, is lingering way behind. It's a clear sign that the small caps are still struggling. They haven't recovered from the situation they were in the last few years. Our team predicts there are lots of downside risk in the economy, so better to be cautious than to jump into any of uh, the huddle. Stay patient, look and read the economy before investing, do your due diligence, and hopefully we see soft landing rather than any harsh effect in the economy. That's everything for today. Hopefully this video will help you all. We will try to bring in more financial topics that will help you to save more money from lending, and we will try to keep you one step ahead. You guys are like one step ahead from the lenders, so that when you are going for a loan, you always know what the lender wants. Have a wonderful rest of your week. Thank you. See you again in the next episode.